Japan's declaration to escape deflation. Japan showed an economic growth rate exceeding 5% from the 1970s to the 1980s. Then, the Japanese economy began to experience difficulties in the 1990s. In November 2009, the Japanese government declared that the economy had fallen into a state of deflation. Since the Japanese government officially declared deflation in November 2009, it has continued its strong policy of providing unlimited liquidity despite various concerns. Recently, as investment and consumption have revived, the goal of Abenomics of 3% growth rate and 2% inflation is becoming a reality. On March 2, the Japanese government began considering a declaration of escaping deflation, falling prices amid an economic recession, for the first time in 23 years, following the rising price trend. The Japanese government plans to determine whether the Japanese economy has escaped deflation by looking at whether a wage increase commensurate with the increased prices will be realized in the price outlook during the spring struggle, when labor unions struggle to raise wages intensively in the spring. Currently, Prime Minister Fumio Kishida and relevant cabinet ministers are discussing measures such as holding a press conference to directly express the desire to escape deflation or specifying their views on economic trends in the monthly economic report. The first time the Japanese government acknowledged that it was in mild deflation was in March 2001. Deterioration in corporate profits due to the continued decline in prices has led to stagnant wage increases. In addition, the Japanese economy has been in a vicious cycle for the past 23 years. With personal consumption sluggish, recently, it has been moving in the low 3% range, which is higher than the Japanese government's managed price level of 2%. This is the first time since early 2015 that Japan's consumer prices have exceeded 2%. At that time, it was only a flash increase due to the Abenomics effect based on the artificial unlimited quantitative easing monetary policy. Consumer sentiment, which showed a slight improvement in 2014, immediately cooled in the following year, 2015. Japan is a representative example of deflation, with a chronic downward trend that continued for 20 years after experiencing a decline in prices in 1994. Japan's deflation was caused by a severe slump in domestic demand after the bursting of the asset market bubble in the early 1990s, which amplified downward pressure on prices. One of the important causes of Japan's deflation was population aging. Last year, the Consumer Price Index, CPI, excluding fresh food, rose 3.1% compared to the previous year, the largest increase in 41 years since 1982, and the Consumer Price Index in January of this year also rose 2.0%. The Nikkei 225 stock average, Nikkei, index, Japan's representative stock market, recently broke an all-time high, creating an environment in which deflation can be determined. Japan has been experiencing a decline in the Consumer Price Index for several years. Compared to the previous year, the consumer price increase rate fell by about 0.3 to 0.9% almost every year from 1999 to 2005. Prices have continued to fall since 2009, right after the U.S. financial crisis, until recently. Until now, few developed countries have experienced a deflationary situation in which prices fall for a long period of time. Just because prices fall temporarily does not mean it is a deflationary economy. The International Monetary Fund, IMF, defines an economy in which prices have fallen for more than 2 years as a deflationary economy. The Japanese government defines it as when the Consumer Price Index falls for more than 6 months compared to the previous month. or when the nominal GDP growth rate falls below the real GDP growth rate for more than 2 quarters. In addition, deflation in the economy as a whole occurs when demand is insufficient compared to supply, so it is easy to think of a recession as deflation. However, prices sometimes fall during good times and sometimes rise during bad times. In this case, the latter is called stagflation. The reason for the lack of demand in Japan is a combination of several reasons. First, asset prices fell due to the bubble burst. The total decline in stock and land prices between 1990 and 2008 was approximately 1,500 trillion yen, equivalent to 3 years of GDP. The second is the impact of the high yen, strength of the yen against the dollar. A strong yen has the positive effect of lowering the prices of imported goods such as raw materials. But in the case of Japan, exports exceed imports, trade balance surplus, so it has a significant effect in suppressing corporate profits and refraining from investing in facilities. Thirdly, the consumption tax, equivalent to Korea's value-added tax, was increased from 3% to 5% in 1997. Additionally, a bill to increase the consumption tax to 10% is currently being promoted to address the fiscal deficit. Raising the consumption tax makes activating consumption not seem easy. In addition to demographic factors such as a decrease in the working age population and aging population, people believe that prices will not rise in the future. The falling expected inflation rate is also a major factor reducing demand in Japan. Meanwhile, due to globalization, one price for one thing is happening all over the world. And as a lot of cheap products from emerging countries such as China are flowing in, prices in Japan, which has a relatively high price level, tend to fall. It seems difficult for the Japanese economy to escape the deflation situation for the time being. Once you fall into the deflation trap, it is not easy to get out.